Let's head back to markets. Wall Street and Main Street both watching the Federal Reserve today. The Fed is expected to raise rates for the second time this year. But will Chairman Jay Powell signal a faster pace of rate hikes in the coming months? That's the question we're going to ask. Join us now, Jonas Ferris, MaxFunds.com co-founder and FBN contributor, John Thomas, Chief Investment Officer at Global Wealth Management. Good morning. Thank you very much for joining us.
Thank you.
Thank you. So I know the market right now has already priced in essentially a rate hike for this afternoon at 2 p.m. What about the dot plot, which pretty much projects future interest rate hikes in the future? What are you expecting to see on that? And I know that the Fed doesn't want to type up this dot plot, but it's what the market cares about.
Well, the short-term rates are not going higher than 5-year rates and 10-year rates, which are under 3%, which are around 3% now. So there's a very limited room here how much higher they can go. They also can't go a lot higher than other countries who have still substantially lower interest rates without the flood of money coming here driving up our dollar, which potentially could hurt the economy. So I think there's a limit here on what they're going to do based on the other global economies, which are also improving, but are nowhere near as strong and don't have high inflation growth expectations like we have here either.
Thank you, Jonas. And I just want to switch it over now. So can you explain just more about why the language is so important in these meetings? We often parse over the wording and adding a certain word like systemic back into the Federal Reserve meeting language. Can you talk about why that's so important for our viewers?
Well, what really matters is what they're going to do, how aggressively they're going to go in the future, and they don't really want to tell you exactly what they're doing because they don't know what they're going to do. They're watching things that are unfolding right now. For example, they're watching trade wars. If there's going to be a trade war, tariffs in all these countries, they're not going to want 3% rates and going into that on top of rising prices because that combined effect could cause a recession. They're very leery of causing recessions by raising rates too high, but they also don't want inflation to pick up. So when they start to forecast the future, they're trying to kind of keep you going without giving you too much, basically.
Jonas, just a moment. We want to let our viewers know that Donald Trump, the president, is actually walking down the stairs. Y'all continue talking, but here comes President Trump getting into, of course, his motorcade because of whether he's going to have to take that motorcade to the White House versus taking Marine One. But just wanted to show our viewers right now these live pictures we're getting from Joint Base Andrews, the president, a long trip back from Singapore, and obviously he's waving to the cameras, wondering if he's going to say anything. Doesn't look like it. It looks like he's saying something. Do we have audio, guys? Guess we don't. Okay. No. All right. Well, he said something briefly, and there he goes. But anyway, sorry, guys.
And John, I got to get to you because we haven't spoken to you yet. John, just tell me about the fact that if the market's pricing in rates going higher, you've got a yield curve that's flattening. What kind of risk can we expect in the near future?
Yeah, we've got to be careful about the yield curve rising, and we've got a flat yield curve, flattening yield curve, and you've got to be careful about that, and you've got to make sure that you look and have enough growth in the portfolio to offset that flattening yield curve. You've got small cap stocks have been a way to play this stronger dollar that was mentioned earlier. The Fed is very concerned about the stronger dollar, and I don't think that they're going to get to the point where the dollar gets too strong and then ends up weakening the economy. So small caps are a good way to play that.
And John, you just brought up the dollar. The dollar actually climbed higher yesterday after there was talk about possible press conferences after every single meeting. Why would a press conference just move the dollar? Just explain the connection there for our viewers.
I think that was a bit of an indication that perhaps the Fed wants to be able to raise rates at every meeting instead of every other meeting. I think that the market has kind of taken this cue that the Fed only raises rates on these press conference meetings. And I don't think the Fed wants to have that indication out there, or for that matter, they want to be able to say, hey, we can skip a meeting, we can have a press conference and not necessarily have a rate hike.
All right. Thank you very much, John. I know it's been short with both of you, but Jonas and John, thank you very much for joining us talking about the Fed meeting.